All right, my friends, so I got an email from Kathy. She's worried about the index funds being dominated by the big three, which be State Street, BlackRock, and Vanguard. She read an article from Investopedia, which we'll dive into. I frankly don't think there's anything to be worried about, but let's go into this for sure. So good email from Kathy. She goes, what should we do? What should we do? So here's some Investopedia. Dateline just the other day, May 28th, 2019. I'm sitting outside my hotel as I'm getting ready to go down to see my man Dustin down at Jazz Well to do a joint video. So let's read this article while I'm waiting on getting out of here. How index funds are hurting investors and the market. Matthew Johnston is the author. The increasing popularity of investing in passive index funds might be killing capitalism's greatest engine of innovation. Competition. For the love of me, man. Since 2010, actively managed funds have shrunk from comprising 75% of all fund assets to just 51%, as passively managed funds have grown to 49%. This trend could have adverse consequences, argues University of Chicago Law School professor Eric Posner. At a recent investment conference, Posner expressed concern that the rising growth of passive investing and concentration of ownership of index funds is undermining competition. I did a video not too long ago about how Vanguard dominating, and the big three, and Bogle talked about that obviously before he died. The big three owning the majority of shares in companies is bad. I get that, but it's not bad from a competition perspective, certainly not bad from a capitalistic perspective. It's bad from a public policy perspective because as Vanguard and all these other guys go with the political winds of the time, be it green climate change fighting and things like that, they can put board of directors who fall for the false promises of climate change, of whatever the issue is at that time. I mean, without question, you go back, 50 years ago, Jim Crow laws. I mean, these things, you couldn't, just you name it. I mean, when you got a dominant share class ownership by three companies who, State Street, I think they're publicly traded, BlackRock, Vanguard's owned by its shareholders, so theoretically, the shareholders say enough of the green nonsense. But I mean, to be perfectly honest with you, how are you going to compete against these big wigs on Wall Street? And the answer is no. So when you have the big three, being politically minded to try to keep the pitchforks at bay, they're going to use their voting power to talk about whatever the political winds of the day are. Right now, it's green energy and whatnot. It's just the silliness of that all. But it is problematic for the companies that are in the S&P 500. That's not every company out there. So let's talk about this and why I'm not in the least concerned. The problem with common ownership in index funds is that you have institutional firms like BlackRock, Vanguard, and State Street becoming the biggest owners of companies like Ford and GM. It hurts these companies' incentive to compete with each other, leads to higher prices and slower economic growth. That's the theory. Yeah, the theory. Professors with their theories. Who would ever thought professors and their theories would be wrong? Oh, they only believed in socialism and Marxism and communism and all that. So not in the worst concern about a professor and his theory. All right, so the index funds control 17.2% of U.S. listed companies, up from 3.5% in 2000. All right, that, again, well. What it means for investors. As firms compete among each other for a greater share of profits, they have an incentive to innovate. All right, so are firms not competing with each other for a greater share of profits just because they're owned by 20% or 25% of the big three? By producing new innovative products for consumers, they can distinguish themselves from competing firms, and by creating new innovative methods of production, they can drive down the production costs and lower the prices. That's how it's supposed to work under capitalism. The problem for index funds, and specifically their concentration of ownership, poses to this engine of innovation is that it lessens incentive for firms to compete. So here's the example. If traditional rivals such as Coke and Pepsi are owned by the same shareholders through an index fund, then there is less reason for the two soft drink makers to compete with one another for the greater share of the profits. With less incentive to compete, there's less incentive to innovate, hurting both consumers and the investors in the long run. What could possibly be to solve that issue? What could possibly solve this issue of the bigwigs being slow and not nimble? What could possibly be out there to solve that? If you want to take a guess, think about it. You got the bigwigs. They're not nimble. They're not quick on their feet. They're slow to adapt. What could be the solution to that? In just 20 years between 1995 and 2015, the proportion of companies that had the same large common owners grew from 20% to 80%, leading to a major concentration of ownership. Investors are obviously attracted to the low fees and high liquidity that big firms can offer precisely due to their scale, but this gives these big firms unprecedented control as it is their investment managers that act on behalf of the client. Shareholder rights. Even the late Jack Bogle, legendary investor and creator of the very first index fund, expressed concern about the high concentrate of ownership that has resulted from the growth of index fund. He worried that if the index funds ever owned half the market, they could own as much as 30% of all U.S. listed assets. Then these firms would wield unprecedented power. I agree with that. That's on the firms wielding unprecedented power. It has nothing to do with the lack of innovation, though. I mean, that's silly. What drives stock prices? Bogle has said this, and you should understand it. It's not the voting rights of the companies. It's price, earnings growth year over year, and dividends. That's it. There is some appreciation or depreciation depending on the feelings of various investors out there. At the end of the day, it's earnings growth increase and dividends. That's what drives prices on stocks. Nothing else matters. Yes, we have years where the PE's up to 45 like we had in 2000. Yes, we had the years where the PE's at 6 like we had in 1979. But that's an anomaly. What drives prices is earnings growth year over year. So if Pepsi and Coke are unwilling and they're unwieldy in their desire to change and innovate, there is going to be another competitor that comes to the market. Literally don't know what it is. But there'll be salsa that competes with Heinz and Hunt's ketchup. There'll be something else, an innovative company or a guy or a lady says, these guys are silly. I'm going to compete for this and I'm going to win. The innovative is what makes capitalism work. It's not the big wigs and their monopoly money and their top hats and all that. It's an innovation that individuals have using their creative minds to get out there in the marketplace and compete. And this is what happens with big government. Big government, big business, big labor. This is essentially fascism. They say, look, we're not going to take over the means of production, but we're going to tell you who can compete. This is exactly what's happening in Europe. Certainly wanting to be happening by the left here and some on the right here in the U.S. as well. And they're saying, if we can tell you how to compete, we're going to make so many rules and regulations that the innovative guy tinkering in his basement or tinkering in his garage won't be able to come to the fruition, won't be able to come public, and will not be able to compete. And when that happens, my friends, that's when the doomsday comes, because then you have a lack of competition. So now you have public policy driven by the big three. I get that from a shareholder perspective. You're like, oh, it could be unwieldy. It's not unwieldy until it finds its way into public policy. And public policy will eliminate competition, because that's what corporations do, is they strive to get government to eliminate competition. Why under God's green earth do you think Amazon was pushing the $15 minimum wage? Do you think it was because they cared about the employees? No, because they knew they could eliminate the competition if they made the price of labor too high for some guy in his basement or some guy in his garage or lady to be able to go out there and bring something new to the market. So Amazon says, you can't compete to get employees because we're offering $15 an hour minimum wage. And some guy says, man, I'm just trying to freaking survive the next month. I can't pay $15 an hour plus benefits. Ironically, don't tell anybody, but Amazon, you know what they've done, right? They've laid off a bunch of people and say, hey, we're going the robot route. So we got the positive press of $15 an hour minimum wage, but all those jobs are going to be gone anyway. I'm not worried about this at all. I'm not worried about this in the least. I am worried about big government, big labor, and big business. I'm worried about the lobbying power of the people with the money who aren't you and I. And once those people take over, the George Soroses of the world, you might even say the cooks from the libertarian cooks who can't stand the Trumpster. I'm not worried about the big three, other than the stupid green stuff. I am worried about big government dictating the small guys can't compete. That's what you need to be afraid of. That right now is not a problem, but it certainly could happen in the future. All right, so hang in there. Don't worry too much. We'll see you next time.